Hey traders, Nick here recapping the week ending 4/20. So Friday ended on it was a tough day, but it could have been uglier, I guess. It was ugliest for the Nasdaq, which was fell. Let's see here, 1.6-ish%. Let's see if I can show you the Qs. Probably the best way. So bad candle, but we did have, it just basically erased all the good news that we had the last few days. Why? Because it was just a continuation of the day before, only with juice. What is that? I'm going to mention it here. The hideous performance of Apple. Yesterday was a bad day in Apple. Gap down, closed on the lows. This morning was even worse. Down 4% on the day, folks. After a gap down, after a bad day yesterday. So if you want to look at it, if you want to touch the high, to just this week from top to bottom is 7.5% correction in Apple. That's the best company on the planet. What was the trigger today? Yesterday was just rumbling of the Taiwan semiconductor and extrapolating into things that are bad for Apple because demand from their suppliers. It wasn't mentioned specifically from TSM, but that was the inference. So today was an actual, I think JP Morgan came out and said that we're cautious into earnings, things could be bad, iPhone 10, etc. And they lowered the price target from, get this, $203 to $200. So they lowered the price target $3, and it's still $35 off of what it closed today. Yet people just chose to ignore the fact that they're still looking at $200. I don't know why they issue statements like that. What good does it do? When you lower your price target from 203 to 200, why don't you say things could be bad, but we're holding long? Obviously, if you have a price target of 200, you're not selling the stock, but you would guard against a dip. So anyway, very confusing statement from a big bank. We'll see. More on Apple a little bit lower. So the day was bad, and it was worse for the Nasdaq. The S&P was a lot better. I think it was 0.8% down on the day if you look at the SPY. And best of all was IWM, which is the small caps, and they have no mega caps in there because the dip in Apple took Microsoft with it. So it was just a colossal mess that way. So all right. So that was the day. It ended badly. So did the week end badly as well? Well, you know what? Here's a summary of all that happened this week. These are weekly candles. S&P right here had a green candle. All of them had a green candle into midday, at least. So the last minute sell-off was you turned the weeks into red, but barely so. Let me back up a little bit. So the reasons why we fell, I wanted to tackle that. All right, so the reason why we fell is, let's see here, I didn't have it in here. Okay, so we'll switch to it. It is the fear. There are two factors. Obviously, Apple down 4%. Mathematically, Apple all by itself, the dip of 4% is almost down 0.8, if not a little bit more, on the QQQ for the Nasdaq. That's the mathematical effect. So if the Qs were down $1.60 at 1.6% on the day, which they were, half of it was Apple. So if you bring Apple to zero, it would be only down 0.8%, but Apple is a heavyweight in there. So this is a representation of the 10-year yield. If you remember on 2.2, the right here on that candle right there, markets fell apart and we started the correction. Why? Because we saw a great jobs report which scared people and rates spiked, the 10-year yield specifically. CNBC and company go out and say, oh my gosh, the world's going to end if we hit 3, which is that white line. Since then, we rallied with rates several times. When we started falling on tariff stuff and then rates will climb, we rally with them. Even though that's what caused the correction in the first place. Well, guess what, folks? Here we are back again. And we've been ignoring them for a while, but now we're approaching 3 fast. So now the rhetoric of, oh my gosh, the planet is going to stop turning at 3. So, okay, higher rates are not great for stocks, but it's not going to make Apple to sell, 50 million less iPhones if we are at 3.05 versus 2.95, which is where we're at right now. Okay, so it's a line in the sand. We have to live with it, and we have to manage our risks accordingly. We had a lot of Fed heads talk, I think the last of which was Kashkari, Neil, and he said he doesn't see a reason to raise any rates, basically what he was saying, which is usually dovish, because he said, the yield curve is inverting, but not the way we think it is anyway. So I read into he's not going to be, pushing for higher rates faster than normal. He said we are close to neutral at this point, which to me is that whatever is going on with the Fed, they're going to stay at the status quo versus start to step on the pedal harder on the raising rate. So that was reason number 2. So Apple and rates fear. There were a few other issues, but these are the 2 major ones, okay? So back to the week summary. So the week wasn't that bad. It was just barely red. It was green for the small caps. It was green for FANG, believe it or not, because A, Apple's not in there, and B, Amazon is. VXX, that's fear, was red. So overall, fear fell. TLT bonds red, obviously, because we had a big spike in rates. Bonds and rates go in opposite directions. So financials also eked out a green week. They ended well. They had a hideous day yesterday, but since rates rallied today, a lot of the banks that I have are greens. And I love Visa, for example. All right, so this is the quick snapshot of what happened for the week. We tackled what happened on Friday, we tackled the why, and we tackled what happened for the week. So what about next week? Well, next week is going to be a massive, I don't think you can see that. Let me see here. Can I do that? There we go. So this is the next week's reporting, the earnings. It's going to be massive, and especially on early in the week. If you look at the market cap in billion, it's going to be big. So we have a lot of companies reporting. That's the bottom line. So it's going to be, we do have other reports coming out, economic reports, but I think all eyes are going to be A, on Apple, and B, on the companies that are reporting. Apple is not reporting next week, I don't think, until early May. So we're looking at Google, etc., Microsoft, I believe so. But I'll lay it out in detail later. So it's going to be all about the earnings. They will either make or break this. If you remember, we had 2 scenarios in the S&P. I'm jumping ahead. But it will determine if we do this or we do that and lower. The earnings. Okay, so that's next week. Technically, we still have some good things going for like that white line right there. If we break through it, it will launch, retest the highs. We can draw the same line or similar line in the small caps. By the way, small caps, also jumping ahead, are 2.5%, just a little under 2.5% over below all-time highs. So we're not that bad a shape. All right, so here we go. That's the scenario of the S&P. So we do have 2 interim scenarios, which are in the write-up. But for the most part, I'm still looking to either, another test a little lower or 2750. Okay, so what about the levels? Let's tackle the levels one at a time. Here we have the Qs, and they're interesting here. And those are the heavy. That's the NASDAQ, heavy with Apple, FANG, etc. And that's what's going to do it next week. We're right in the middle of the regression line. This is, I believe, a 2-hour chart. So it shows a pretty pivotal zone. Why? It held this support somewhere early March. We rallied, came back to it, we fell below it, and then we had an inverse head and shoulder that priced almost exactly to where we wanted to go. It makes sense that they stopped here because of this right there. That was the accident scene of the crime. Remember? That's a gap that they just barely closed it. So what now? Is it support so we can build higher, or coin flip, right? So earnings, short-term reaction to earnings, or coin flip long-term, I still like them. The IWM, that represents the small caps, that's all-time high. We tagged it here, and we are just here, just a hair below it. So I'm not scared if I'm long IWM, for example. All right, so these are the levels. And as far as the 10-year note I just showed you, that's another picture to show the levels. All right, so what about Apple? That's the other problem. First problem was the 10-year note, and then the other one is Apple. I added this bar right here, this green bar, because that has been pivotal. So here's a lesson in, what do you call that? Technical analysis. So this is Apple, right? So back in wherever in 2016, we rallied in September. We rallied and hit this one, and that was resistance, and it failed. And then came back here, boom, broke out and went up. Right? Came back to it. You can argue that this was support. They tried to bring it down, but they didn't even touch it. They tried to bring it down again. They didn't even touch it. So support twice. They brought it down again, and they overshot lower. But that was, we had the confluence of headlines, tariffs, and all kinds of junk. So it is support since we bounced off of it, or through it, but it doesn't matter. So pivotal, let's call it neutral at least. Here was definite support, emphatically. This candle here was emphatic, whatever that happened, I can't remember. So here we are. Now what? Okay, so that's why I put that bar in there, because we're in a zone where if you're long Apple, or if you're looking to go long Apple, if you can't bet on the best company on the planet into earnings, or at least into for the next 6 months, then the whole market is in deep Bandini. So it is viable that it's in deep Bandini. But if I wanted to take a flyer on something, I would trust my money. In fact, I did take some longs today on the big dip in Apple. How did I do it? So what I did is I did two things. I took a lottery ticket by buying a call, and where did I do it? I took June 1st, so I left some time on the clock, and it was, I believe, 167.5. So basically, any bounce higher, and I'm in the money right away. It costs a lot of money, but I have a short leash on it. I mean, Apple's not going to go to zero. I'm going to be able to salvage some of it. That's why I went out in time. I also did something else. So, see that number right there? All right. So I sold somebody a lottery ticket for September. I collected, what is it now? 1.7, 1.6? I can't remember. Something like 1.6. Let's call it 1.6. $1.50 or more for a put. Oh, I remember. It was $1.67, I believe. So somebody paid me $1.67 per contract to buy Apple at 130. So I committed by selling that I will buy Apple at 130 if it falls through 130. Okay, so I ask you, would you buy Apple at 130? Given what I know now about the whole economy for the next 6 months, yes, I would. And that's what I did. So I'm on the hook until September for that. And I can close it at any point in time, buy it back. So somebody bought a lottery ticket from me at 130. If Apple falls through 130, my break-even point is $1.60 lower than that. So I'm pretty sure I'm not going to go broke doing that. So I'm willing to own it at 130. Therefore, I sold it. I could have done a credit put spread instead and just collected a premium down there to limit the risk. And I could also buy spend 30 cents to buy a 130 put for, say, June. Or I don't know how much it is. I'm just estimating it'll be 30 cents. This way, if the market falls to zero, I won't lose anything between now and June. I call these sacrifice puts. All right. So this is what I did today with Apple. That's my own choice, my own parameters. Okay. So there's also, we need to look at bonds. All right. So because we're looking at rates, which is problem number one, the opposite of rates are bonds. Now, for years, they've been calling the death of bonds because, oh my gosh, we're in a rising rate environment. I mean, rates are at zero. It only makes sense that bonds are in a bubble. Maybe they are. This is a quarterly chart. I rigged it. I just did a 90-day. There's no such thing as a quarterly chart, so I rigged it and did a 90-day. And it shows that bonds are entering. I do have several levels that coincide right here, just below here. So what happens in that circle for bonds will determine what's going to go on in the stock market for good. Because if they lose that white trend, then they have a downside that's going to shoot them way lower. But they also have good support right here from this bar. So they've been tested. They've been tested hard here, but they bounced off it every time. But the problem with that is, if it breaks, it looks like a head and shoulders with a whole bunch of downside, which will bring it down to here. Okay. Now, bonds are typically, under normal circumstances, a good bet against the stock market. So, under normal circumstances, if I wanted to hide in something away from stocks or hedge a stock bet, I would buy bonds. But in this case, for now, they're in the same bucket because we, the investors in stocks, are fearing the rates, which means that we want bonds to go up. So it doesn't make sense for now, but I'm just saying. So I did take a long position in bonds. It's a little red, but it's just a flyer on maybe they're still wrong. Maybe the bond vigilantes, whatever you call them, are still wrong. All right, so that's it. We had a scary day, but it could have been a lot worse. The two problems were Apple and rates because we're scared of this white line right here. So that leaves us between two scenarios. Retest the lows or some lows or the neckline. So that's the other thing. So even if we fall to that scenario below, it's not an automatic game over because this was a line that was fought over as resistance, and then they bounced off of it, and we're getting tested. So this is the test. Sometimes prior resistance becomes forward support. So that's why I put this right here. Don't bounce. Okay? So Nick signing out. If you have any questions about the trades, I'm going to do homework over the weekend. There's tons to be done here. I just refrained because of this uncertainty in the air. I didn't want to influence anybody's decision to jump too soon. All right, Nick signing out.